Welcome back, investors, to Ticker Time News. I'm Adam, and last week, credit card companies MasterCard, Visa, and American Express all reported strong quarterly earnings, signaling that consumer spending held up quite well in the face of the Omicron variant and inflationary pressures. These encouraging reports provided a bullish data point for digital payment processor PayPal ahead of its Q4 earnings. While expectations were rising that PayPal would rebound from a disappointing Q3 performance, the fintech pioneer stumbled badly and missed EPS expectations while issuing downside EPS and revenue guidance for fiscal year 2022. The lingering impact of withdrawing from eBay's platform did significantly weigh on PayPal's revenue growth in Q4. In fact, if you include eBay, revenue was up 22% on a spot basis, compared to the reported growth of 13%. But the company's issues run much deeper than its exit from eBay. And here's why. Most troubling is PayPal's new net active accounts, NNAs. That guidance for fiscal year 2022 is off. After adding 48.9 million NNAs in fiscal year 21, the company is forecasting only 15 to 20 million NNAs this year. Also, during the earnings call, PayPal's CFO said that the company's goal of achieving NNAs of 750 million by 2025 is no longer valid. PayPal's CEO and CFO both tried to calm investors and analyst concerns, commenting that the projected drop-off is partly by design as the company focuses on driving revenue per account higher. While dialing back on incentive-based marketing campaigns, minimally engaged accounts are expected to just roll off. And I guess I can see that point because its Q4 payment transactions per active account were actually higher by 11% year over year to 45.4. Okay, I guess I can see that point because its Q4 payment transactions per active account, they were actually higher by 11% year over year to 45.4. So perhaps the increase is mainly attributed to higher value accounts. But the sudden shift in its strategy is definitely catching many people off guard, including myself. In light of the solid earnings report from the credit card companies and the magnitude of the expected drop off in NNA growth for PayPal, it seems fair to assume that intensifying competition is taking a toll on the company. And perhaps that's what's really going on here. PayPal's issues are not limited to fading revenue and NNA growth, as non-GAAP operating margin contracted by 290 basis points year over year to 21.8%. The company's Q1 and fiscal year 22 EPS guidance fell well short of expectations, indicating that margin pressures will continue. This concern is mitigated just a little bit because PayPal's fiscal year 22 earnings will be negatively impacted by higher taxes and a provision built for more normalized credit growth. The news isn't all bad for PayPal, though. For instance, Venmo's momentum remains strong, with total payment volume up 29% to $60.6 billion. Also, the drag from eBay, it will finally subside this year, and PayPal will begin lapping easier year-over-year comparisons starting in Q2 of 2022. These silver linings, though, are completely overshadowed by PayPal's soft outlook and competitive landscape. Well, that's what I think about PayPal's disappointing earnings right now. But I want to hear from you. What do you think about PayPal's slowing growth? Is it really competition heating up or something else? And remember, your comments make these videos so much better. Smash that like button, share this video, and click the first link in the description for our top 10 list and so much more. Thank you so very much for watching, and I will see you in the next video.